All right, super quick video on why I don't think you should ever let your options expire worthless, even if you're in profit and the probability is that they will continue to stay out of the money and expire worthless. And here's why. Let's go into options Omega. I'm just going to do a quick 2-year back test, and we're going to do IWM, something different. We are going to do a short put spread, also known as a put credit spread, and I'm just going to leave the defaults in here. So by default, we're selling a put with a delta of 25, about 10 days to expiration, and about 10 points wide here, which is pretty wide, but you know, we're just trying to do an illustration here. We're going to start with a $100,000 account. We're going to allocate 5% of the account to this trade. And we're just going to let it go. And basically, we're going to take the trade every day at 9:45 a.m. It's going to open a new trade, again, about 10 days to expiration. And we're going back 2 years. Let's just run this. So this is not a real strategy. I'm definitely not recommending you trade this. I just want to merely show you the difference between letting it go to expiration and taking profits. So first of all, we can see that this was a losing trade, as I kind of mentioned. It did well for a while, but then ultimately it succumbed to losses and ended up down on the account over the past 2 years. Now, it did, however, this is interesting to me, had a 77% win rate. So I want you to think about that. The next time someone's touting their win rate, just know that you can have a 77% win rate and still lose money, right? There's more to it than that. You have to know what the strategy is to look at win rate. I think it's an important metric, but you got to keep it in context. The interesting part here is that since we were selling at delta 25, that means that this strategy loosely would have a 75% win rate, because what delta 25 also means is that's the percentage of time this thing's going to expire in the money. And this actually kind of played out over the past 2 years, because if it's supposed to expire in the money, that would be a loss, but it actually expired out of the money 77% time. So this means that this is actually pretty close to what it should be, what the options market probability market should be pricing, but again, it's a losing strategy. So let's do the same test. The only difference I'm going to make is that I'm going to put a profit target of 50%, meaning if we sell the spread for whatever credit, let's say it's $1, then if we can close it for 50 cents, we will book half the credit and then move on to the next trade. So we're going to run this, and this particular strategy, it's going to open a new one every day, which means you would be in multiple trades. So that's what I want to show you. And look at this. We went up to a 92% win rate for this strategy and actually made pretty good money. It had a CAGR of about 8%. That means, you know, we started with $100,000 and ended with $116,000. And again, not a real strategy. Don't recommend it, but I just wanted to show you that letting your options go to expiration does not always work out. The odds are not going to be in your favor when it comes to that profitability. Hope you enjoyed the video, and we'll see you in the next one.